In 2019, a Vanguard study tracked roughly 1,500 investors over a full decade. The ones who performed best were not the ones who picked the right stocks or moved their money at the right time. They were the ones who automated a small fixed amount and then essentially forgot about it. Some of them had invested as little as $35 a week. Most people hear that number and assume it cannot matter. We have been trained to believe that wealth comes after the big salary, the promotion, the windfall. That if you are not moving serious money, you are not really in the game. Here is what that belief leaves out. $35 a week, invested consistently over 30 years, does not produce a modest savings account. It produces something close to $1 million. And here's what makes that number stranger. Less than 55,000 of it came from you. The rest was created by a mechanism that does not care how much you earn. That mechanism is what this video is about. If you do not understand how it works, your savings can keep growing and still fall behind because you are solving the wrong problem. My name is Alex, and if you have ever looked at your account balance and felt like the math should be further along by now, pay attention here, because wealth and income are not the same thing, and most people spend 40 years confusing them. I'm going to show you exactly how compounding turns a small weekly habit into a self-sustaining income engine, and why the size of your paycheck has almost nothing to do with it. Once you understand this, you will stop trying to earn your way to security and start building something that works whether you show up or not. And to see why that shift matters so much, you first have to understand the problem with depending on a paycheck in the first place. It comes down to a distinction most people never think about: the difference between rented income and owned wealth. Here is something worth sitting with for a moment. The average American household income in 2026 sits at around $78,000 a year. That is a real wage. That is 40 years of education, promotions, performance reviews, and trade-offs. And yet, study after study shows that the majority of people earning that kind of money still feel financially stuck. Not broke, not irresponsible, just stuck. Like they are running on a treadmill that keeps speeding up. That feeling has a mechanism behind it. And once you see it, the treadmill makes complete sense. Think about a guy named Marcus. He is 34, works in project management at a mid-sized logistics company, and earns about $82,000 a year. By any reasonable measure, Marcus is doing fine. He pays his bills. He contributes to his retirement account. He does not live extravagantly. But every month, without quite understanding why, the number in his checking account feels about the same, sometimes lower, rarely higher. He has started to wonder if he is missing something. He is. But it is not a budgeting tip. It is a structural problem. The money Marcus earns from his job is what you would call rental income. He trades his time and effort for a paycheck, and the moment he stops, the money stops with him. It does not matter how good he is at his job. It does not matter how long he has been there. The income only exists as long as he shows up to produce it. That makes it fragile in a way that most people do not fully appreciate until something goes wrong. Now here is where it gets interesting. Even when Marcus does everything right, that paycheck is under constant pressure from three directions at once. The first is taxes. A salary of $82,000 does not land as $82,000. After federal income tax, Social Security, and Medicare, Marcus takes home somewhere around $57,000. He earned $82,000. He keeps $57,000. That gap never closes, and it never gets smaller on its own. The second pressure is lifestyle creep. This one is quieter. When Marcus got his last raise, about $4,000 extra per year, he did not make a conscious decision to spend more. But within 6 months, his subscriptions had expanded. His grocery habits had shifted slightly upward, and his car payment was a little larger than the one before it. The raise disappeared without a single reckless decision. That is how lifestyle creep works. It does not announce itself. It just adjusts your baseline. The third pressure is the one that never stops, even when Marcus is asleep. Inflation. In 2026, the cumulative price increase on everyday goods since 2020 is sitting at over 22%. A grocery run that cost $80 6 years ago now costs closer to $98. His salary has gone up, yes, but so has everything he buys. The purchasing power of each dollar he earns keeps shrinking, quietly, every single year. So take a step back and look at what Marcus is actually dealing with. A significant portion of his income disappears before it reaches his account. A portion of what remains gets absorbed by a lifestyle that expanded to meet it. And the portion he does manage to save is losing ground to inflation in real time. He is not doing anything wrong. The structure itself is the problem. And this is the part that most financial conversations skip entirely. They tell you to earn more, spend less, and save the difference. What they do not tell you is that rental income, no matter how large, has a ceiling built into it. You can push that ceiling higher, but you cannot remove it. The only way out of the treadmill is to build something that does not require you to keep running, that something exists. And the gap between what Marcus has now and what that something could look like in 30 years comes down to one force. A force that does not care about his salary, his tax bracket, or how expensive eggs have gotten. It only cares about time. That force is compounding. And the way it actually works is nothing like the way it gets explained. Most people have heard of compounding. They nodded along in a personal finance class or skimmed past it in an article. They get the basic idea. What almost nobody gets is what it actually feels like to live through it, and why that feeling is precisely what causes most people to quit at exactly the wrong moment. Start with the mechanics, because they matter more than the metaphor. When Marcus invests $35 in a given week, that money earns a return. Let's say the market delivers roughly 10% annually, which is close to the historical average of the S&P 500, going back nearly a century. That return then gets added to his balance. Next week, the return is calculated on a slightly larger number. The week after that, slightly larger again. The growth is not coming from Marcus working harder, and it is coming from the previous growth, generating its own growth. That is the entire mechanism. Simple in theory, brutal in practice because of how long it takes to become visible. Here is the actual timeline, and it is important to sit with the discomfort of it. After 5 years of consistent $35 weekly investments, Marcus has about $6,800. He has put in just over $9,000 of his own money. The account is worth less than what he contributed. On paper, that looks like failure. It is not. It is just the early part of the curve, where the snowball is still small and the hill is still steep. At year 10, the balance reaches around $32,000. His total contributions by that point are just under $18,200. And the gap between what he put in and what is there is starting to open up. But $32,000 does not feel like a revolution. It feels like a modest emergency fund. Nothing about it signals that something significant is building. And that is the trap. Think about what Marcus is experiencing at year 10. He's been disciplined for a decade. He has automated the investment, resisted the urge to touch it, and watched it grow at a pace that feels almost insulting, given how long he has waited. His colleagues are talking about cryptocurrency plays and individual stocks that doubled in 6 months. His brother-in-law just made $11,000 flipping a piece of land. Meanwhile, Marcus has $32,000 and a quiet sense that maybe this strategy is not actually working. This is the most dangerous moment in the entire 30-year arc, not because the strategy is failing, because it does not look like it is working yet, and the human brain is not wired to wait for payoffs it cannot see or feel. There is real research behind this. Behavioral economists refer to it as present bias, the tendency to overweight immediate results and discount future ones. We are not wired for exponential thinking. We are wired for linear thinking. We expect things to grow at the same pace they started. When they do not, we interpret the slowness as a signal to stop. We are wrong, and that wrongness is expensive. The investors who quit between years 8 and 12 pay a price that never shows up on any statement. It is invisible, but it is enormous, because what they walked away from was not $32,000. They walked away from everything that came after it. At year 20, the balance crosses $160,000. The contributions Marcus made represent less than a third of that total. The rest is the compounding doing its work. And then something shifts. The growth that took 20 years to reach $160,000, it produces the next $800,000 in the following decade. That is not a typo. Years 20 to 30 add more wealth than the entire first 2 decades combined. That is what the curve actually looks like. Slow, 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 then suddenly overwhelming. But here is the honest question. Knowing that the payoff is real and the math is clear, what exactly should Marcus be investing in? $35 a week spread across what? Chosen how? That is where the strategy needs a structure, a simple portfolio blueprint that any regular investor can actually build and stick with. There is a version of this conversation that turns into a stock picking exercise. Specific tickers, hot sectors, and the fund that outperformed last quarter. That version sounds sophisticated. It also misses the point entirely, because the question Marcus actually needs to answer is not which investment is the most exciting. It is which structure is the most durable. That distinction matters more than most people realize. A portfolio is not just a collection of things you own. It is a set of decisions about how your money behaves under different conditions. Some assets grow fast and fall hard. Others grow slowly, but hold steady when everything else drops. The goal is not to maximize any single outcome. The goal is to build something that keeps compounding through good years and bad ones, without requiring Marcus to make perfect decisions at stressful moments. So here is what a simple, effective portfolio actually looks like for someone in Marcus's position. The foundation is a broad market index fund. This is the core, something that tracks the total US stock market, meaning Marcus owns a tiny slice of thousands of companies at once. Not a bet on any single business, not a prediction about any single industry, just broad, diversified exposure to the overall growth of the American economy. Historically, that has returned somewhere between 9 and 11% annually over long periods. In 2026, the average expense ratio on a total market index fund sits below 0.1%, meaning almost none of the return gets eaten by fees. This is the engine. Around that core, Marcus adds a mid-cap fund. Mid-cap companies are businesses that are past the chaotic early stage, but still have significant room to grow. They tend to behave differently from large established companies, which means they add texture to the portfolio. When large cap stocks stall, mid-caps sometimes keep moving. When mid-caps pull back, the large cap core provides ballast. They complement each other without duplicating each other. The third layer is a sustainability-focused fund. Now, some people hear that and immediately think it is a political statement. It is not. It is a forward-looking bet. Companies with strong environmental and governance practices have, over the past decade, shown lower volatility and comparable long-term returns to traditional funds. Marcus is not investing in them because of the values. He is investing in them because businesses that manage risk carefully tend to survive longer. That is just prudent thinking. Finally, Marcus adds a dividend-focused fund. These are large, established companies that pay out a portion of their earnings to shareholders regularly. Think utilities, consumer staples, and financial institutions. They do not grow explosively. What they do is generate consistent income regardless of what the broader market is doing. In a portfolio built for the long haul, that steady income stream gets reinvested automatically, adding to the compounding effect quietly in the background. 4 fund types, different behaviors, different risk profiles, all working together. Now, the exact funds Marcus chooses matter less than the principle behind the structure. The point is not to find the perfect combination. The point is to avoid the mistake that derails most small investors, which is concentration, putting everything into one sector, one theme, or one idea. When that idea underperforms, and eventually everything underperforms for a period, there is nothing else in the portfolio to absorb the shock. Diversification is not exciting. It is also not optional if the goal is to still be invested in year 25. And here is the part that deserves a moment of honest reflection. Most of the investors who fail with this strategy do not fail because they chose the wrong funds. They fail because they chose a structure they could not emotionally tolerate. A portfolio full of high growth, high volatility positions looks great on a spreadsheet during a bull market. It feels catastrophic during a correction. Marcus does not need the highest possible return. He needs a return he can stay invested through. That is the whole design logic. Build something boring enough to hold through a crash, diversified enough to capture growth across different market conditions, and cheap enough that fees do not quietly drain the engine over 30 years. And when that engine runs long enough, the numbers it produces are genuinely difficult to believe until you see the math payoff laid out in full. Numbers have a way of sounding abstract until you run them all the way through. So let's do that. Not a rough estimate, not a ballpark. The actual math, start to finish, because the full picture is the thing that changes how you think about what Marcus has been building. Marcus is 34 years old. He opens a brokerage account, sets up an automatic weekly transfer of $35 into his diversified portfolio, and then essentially leaves it alone. No market timing, no panic selling, no yearly overhaul. Just $35 a week, compounding at a conservative annual return of 10% for 30 years. Here's what that looks like in real numbers. At year 5, the balance sits at around $6,800. Marcus has contributed just over $9,100 of his own money. The account is worth less than what he put in. That gap is uncomfortable. It is also completely normal at this stage, and it does not last. At year 10, the balance crosses $32,000. Total contributions are now roughly $18,200. The compounding has added about $13,800 on top of what Marcus actually invested. The gap is opening, but slowly. Still nothing that feels like momentum. Year 20 is where the shift becomes undeniable. The balance reaches approximately $163,000. Marcus has contributed around $36,400 of his own money over 2 decades. The market and the compounding have added another $126,000. He is now getting back more than $4 for every dollar he puts in. The engine is running, and then year 30 arrives. The balance is $942,000. Call it just under $1 million. Marcus contributed a total of $54,600 of his own money across 30 years. That is $54,600 that came from his actual income, his actual decisions, his actual discipline. The other $887,000 was created by the system he built and then left alone. He did not earn that money. He did not grind for it. Time and compounding produced it, and all Marcus had to do was not get in the way. Sit with that ratio for a second. Roughly 6% of the final balance came from Marcus. The other 94% came from growth. That is not a rounding error. That is the entire point of the strategy. Now, here is where the math becomes something Marcus can actually live on. A portfolio worth $942,000 using a standard 4% annual withdrawal rate, which is the benchmark most financial planners consider sustainable without eroding the principal, generates $37,680 per year in passive income. That is just over $3,140 every month, coming in whether Marcus works or not, whether the economy is growing or contracting, whether he feels like showing up somewhere or not. And if Marcus had started at 24 instead of 34, that same $35 a week compounds for 40 years instead of 30. The final balance climbs past $2.4 million. The monthly passive income from a 4% withdrawal exceeds $8,000. 1 decade earlier, starting turns a comfortable outcome into a genuinely life-altering one. That is what a single decade of delay actually costs, measured not in dollars contributed, but in compounding years lost. Here is the honest observation that most financial content avoids. The strategy does not require a high income. It does not require sophistication. It does not require Marcus to understand macroeconomics or predict market cycles. What it requires is time. And the one thing that reliably destroys time in this context is human behavior. Specifically, the very predictable ways that people undermine a strategy that is working precisely because it does not feel like it is working. That is not a small problem. It is the whole problem. Because the math is not what fails people. What fails them is everything happening inside their head while the math is doing its job. And understanding the psychology of that failure is what separates the investors who reach year 30 from the ones who quietly stop somewhere around year 8. Nobody talks about the part where you almost quit. The financial content online is full of the before and the after, the humble starting point and the impressive ending balance. What gets skipped is the middle, which is where the strategy actually gets tested. And the middle is not a market problem. It is a psychological problem. Specifically, it is the gap between what Marcus knows intellectually and what his brain tells him to do when the market drops 15% in 6 weeks. Understanding that gap is what determines whether Marcus reaches year 30 or becomes one of the investors who walked away from $800,000 they never knew they were about to have. Start with the most common failure mode, boredom. This sounds almost too simple to take seriously, but it is genuinely one of the leading reasons people abandon long-term investment strategies. Marcus's portfolio, set up and automated, does not demand anything from him. There are no decisions to make, no interesting moves to execute, no story to tell at dinner. Meanwhile, a colleague mentions a tech stock that returned 60% last year. Someone in an online forum is posting screenshots of a crypto position that tripled in 4 months. The comparison is not even fair, but the brain does not process it that way. It processes it as evidence that Marcus is doing something wrong. He is not, but the feeling is real, and feelings drive behavior more reliably than knowledge does. The second failure mode is panic, and unlike boredom, panic has a specific trigger. In early 2025, the S&P 500 dropped sharply over a compressed period. Portfolios that had been growing steadily for years lost a visible chunk of their value in weeks. For a long-term investor, that event was mathematically irrelevant. The contributions Marcus made during that period bought more shares at lower prices, which means the recovery that followed was worth more to him than if the drop had never happened. A market decline for a consistent buyer is a discount. The same $35 purchases more ownership when prices are lower. But that is not how it feels when you open the app and see the balance down by $4,000. It feels like a loss. It feels like confirmation of the fear that this was always going to go wrong. And the brain, wired for loss aversion, generates a very loud and very confident signal to do something, to sell, to protect what is left, to get out before it gets worse. That signal is almost always wrong, and acting on it is the single most expensive mistake a long-term investor can make, not because selling locks is a loss, though it does, but because it also locks out the recovery. The investors who sold during the 2020 COVID crash, the 2022 rate hike correction, and the 2025 drawdown shared one thing in common. They protected themselves from the bottom and missed the climb back up. They turned a temporary decline into a permanent one. The third failure mode is subtler. It is the temptation of complexity. At some point, Marcus will encounter a strategy that sounds more sophisticated than his, a leveraged ETF, a sector rotation model, an option strategy that a guy on YouTube explains in 12 minutes. These are not inherently fraudulent, and some of them work for some people under specific conditions. What they all require is active management, precise timing, and a level of attention that introduces the exact psychological pressures that Marcus's simple portfolio was designed to eliminate. Complexity feels like an upgrade. Often, it is just a new way to make the same behavioral mistakes with higher stakes. So what does staying the course actually look like in practice? It looks like one question, asked once a week. Did the $35 go in? Yes. Then nothing else needs to happen. The focus shifts entirely from outcome, which Marcus cannot control, to process, which he absolutely can. That shift sounds minor. It is not. It is the entire game. Open a brokerage account. Choose a broad market index fund to anchor the portfolio. Automate the weekly contribution. Then do the hardest thing the strategy asks for, which is nothing. No timing, no reacting. No second guessing a decision that was already made correctly. The strategy is straightforward. What it asks of Marcus is not. Here is what this video was really about. Not investing. Not index funds. Not $35 a week. It was about the difference between money that stops when you do and money that does not. That distinction is the whole game, and most people spend their entire working lives on the wrong side of it without ever understanding why. A few things are worth carrying forward. Rented income has a ceiling built into it, no matter how high you push it. Compounding does not reward intelligence or effort. It rewards time and consistency. The middle of the curve feels like failure. It is not. And the biggest threat to a long-term strategy is never the market. It is the investor. Next time you check your balance and feel like it is not moving fast enough, ask yourself one question. Are you measuring the outcome or the process? Because the outcome is not yours to control. The process is. One thing this video did not cover is what happens when the portfolio actually starts generating income. How you withdraw it, how you protect it, and how you avoid dismantling in retirement what took 30 years to build. That question has its own answer, and it is worth understanding before you need it.